Imagine, imagine you are the CEO of a company.
Okay.
And you've just spent $21 million out of your own pocket to lay miles of state-of-the-art fiber optic cable through the frozen dirt of Alaska.
Right. Not a cheap project.
Exactly. But then earnings day arrives, and Wall Street takes one look at your balance sheet, sees this massive earnings per share miss, and just immediately dumps your stock. I mean, they send it down nearly 6%.
Ouch.
Yeah. So do you panic? Well, if you're the management team at ATN International, or ATNI, the answer is no. Actually, if you listen to their Q1 2026 earnings call, you're cracking a smile.
It's a really remarkable disconnect, honestly. I mean, the market is looking at a scoreboard that flashes a negative 18-cent EPS, missing estimates by 30 cents,
Yeah.
and they just assume the game is over.
Right.
But management is looking at the actual field, and they're thrilled with the yardage they're gaining.
And that is exactly our mission for this deep dive. So welcome in, everyone. We have a huge stack of ATNI sources right here on the table. We've got their Q1 2026 press release, the slide deck, and the full earnings call transcript.
The whole package.
Yeah. And we're going to look under the hood to figure out what is actually happening. Like, is this a telecom company struggling to survive a catastrophic quarter, or a company that's successfully navigating this massive, incredibly capital-intensive transition?
To really understand that transition, I think we have to look past those superficial headline metrics.
Okay.
ATNI is essentially a microcosm of a much larger, often really painful evolution that's happening across global infrastructure right now.
Right, because they don't operate in normal places.
Exactly. They operate in some very specific, often remote and geographically challenging markets. We're talking places like Alaska, the U.S. Southwest, the Caribbean, and Guyana.
Wow.
Yeah, and building and maintaining networks in these regions, it isn't like wiring a dense city block in Manhattan. It's an entirely different beast. And right now, ATNI is actively shedding its past to fund its future.
Well, let's get into the mechanics of that, because looking through these financials, it's a little confusing.
It is.
Their total consolidated revenue for the quarter was about $182 million, which is only a 2% growth year over year.
Yeah.
And, 2% barely keeps up with inflation, let alone justifies any executive popping champagne. So how do they justify this underlying optimism?
You really have to isolate what they're actively selling today versus what they were propped up by yesterday.
Okay, unpack that for me.
So if you look closely at that $182 million, that 2% growth is, well, it's kind of an illusion masking a much stronger core. You have to adjust that base revenue to exclude two major anchors dragging them down this quarter. Yeah. First, there was an absence of construction revenues that artificially boosted their numbers in the previous year. And second, they absorbed the anticipated loss of a U.S. government high-cost support subsidy in the U.S. Virgin Islands.
Wait, hold on. Let's not just breeze past that second one. Why was the government paying them a subsidy in the first place, and why did it suddenly just vanish?
It basically comes down to the fundamental economics of rural telecom. It is just incredibly expensive to run infrastructure to remote islands or isolated communities.
Sure.
And left purely to the free market, telecom companies would never build there because they could never recoup the costs from such a tiny population. So programs like the Universal Service Fund, they step in and provide subsidies to make it economically viable.
Ah, I see.
But those programs aren't permanent. They have sunset dates. AT&I knew this U.S. Virgin Islands subsidy was expiring, so they planned for the revenue drop. It wasn't a sudden failure of their business model. It was just, a scheduled change in government funding.
Okay, well, that definitely changes the picture. So if you strip out the one-off construction revenue and that expired government check, what does the actual engine of the business look like?
If you strip those two expected losses out of the equation and just look at what they are actively selling to customers, their core telecom revenues actually grew by 3%.
I mean, 3% is better, but it still doesn't totally explain the enthusiasm to me. I think I need a better way to visualize what's happening inside this company. It sounds like they're swapping out their very foundations while the building is still open for business.
That's actually a great way to think about it.
Like, think of it like ripping out the plumbing in a house while the family's still living there.
Right.
You have to lay all the new PVC pipes alongside the old corroded, leaking copper ones. So you're paying double the maintenance for a while.
Exactly.
And the value of the house hasn't jumped overnight, and the water bill looks like a mess, but the underlying infrastructure is entirely upgraded. That's the messy transition AT&I is executing.
And you can see the results of that upgrade really clearly when you look at their profitability.
Let's hear it.
Their adjusted EBITDA, which is their cash profit from operations, before all the complex, accounting for depreciation, taxes, and debt, that hit $49 million,
Wow.
which is a massive 10% jump. And their adjusted EBITDA margin expanded by a full 200 basis points to 26.7%.
200 basis points of margin expansion is huge. That basically means they are keeping 2 extra pennies of pure profit on every single dollar they bring in.
Exactly.
So how exactly are they doing that? Like, where is that profit coming from if top-line revenue is relatively flat?
They're strategically growing their high-value segments. For example, they saw a 9% bump in carrier services.
What's carrier services?
It's a wholesale mechanism.
Yeah.
Instead of selling a phone plan to an individual person, AT&I is providing raw network capacity, literally the actual pipes of the internet, to other massive businesses and major national carriers.
Oh, like routing traffic through their remote areas.
Right, routing traffic through AT&I's remote territories. That is highly profitable recurring revenue. And then on the international front, particularly in places like Guyana, they saw a 5% growth in postpaid mobile subscribers.
Now, looking at the transcript, they did see a 1% dip in prepaid subscribers. Is that something to worry about?
Management noted that dip was primarily related to a billing system conversion.
Oh, okay.
Yeah, when you change how people pay, especially in prepaid markets where users have to manually reload their accounts, you always see temporary churn. People get confused, or they miss a notification and they just drop off temporarily.
That makes sense.
Yeah, and the consistent growth in postpaid, which guarantees a monthly check, more than offset that brief prepaid friction.
All right, I understand the plumbing metaphor now. They're building a highly profitable underlying network. But let me just play devil's advocate here for a second.
Go for it.
Because it is incredibly convenient for a company to say, hey, ignore the top-line revenue drop, ignore the EPS miss, and just look at these other customized metrics instead.
It is convenient, yeah.
If I'm an investor listening to this, how do I know this isn't just financial smoke and mirrors? And this exact tension actually came up during the Q&A portion of the earnings call.
It did.
Analyst Greg Burns pointedly asked CFO Carlos Doglioli why AT&I abruptly stopped disclosing their total broadband homes passed and their total subscribers.
Right.
When a company stops reporting total subscribers, my alarm bells start ringing. Are they hiding a mass exodus?
It is exactly what you should ask when a company changes its reporting metrics midstream. But Doglioli had a very specific mechanical defense for this. AT&I is actively decommissioning their legacy copper network products.
Copper, like the old school landline telephone wire that the internet used to run on.
Yes, exactly. Copper degrades over time, it requires immense physical maintenance, and it has a hard limit on the amount of data it can carry. It is basically a dying technology.
Sure.
If AT&I continues tracking total subscribers, that number includes thousands of people clinging to a network the company is actively trying to kill off.
Oh, I see.
It muddies the water. If they lose a copper subscriber, that actually looks like a negative in the total subscriber column, even though it reduces their maintenance costs. So management is telling the market, look, the only vital metric you should care about going forward is high-speed broadband.
And what qualifies as high speed in their book? Like, what's the threshold?
They define it strictly as download speeds of 100 megabits per second or greater.
Okay, so they're saying don't judge us on the people holding on to dial-up speeds, judge us on the people buying the modern fiber.
Exactly.
So how do the numbers look when you isolate that high-speed metric?
They look incredibly strong. Their high-speed broadband homes passed exploded by 24% year over year. They're now passing over 523,000 homes.
Wait, 24% in a single year?
Yeah.
That is massive.
How do you physically lay that much fiber optic cable through the frozen tundra of Alaska or the mountains of the Southwest in just 12 months? Well, you don't. And this is a crucial mechanism to understand. A massive chunk of that 24% expansion was not from trenching fiber underground.
Really?
No, it was from fixed wireless deployments they executed in Alaska during the second half of 2025.
Explain fixed wireless to me. Why does that scale so much faster?
Well, trenching fiber is slow, and it's expensive per foot. You have to dig up roads, navigate property lines, battle the weather. Fixed wireless is a game changer for these remote areas.
How does it work?
Instead of running a physical cable to every single house, you run one massive fiber line to a central elevated tower. Then, you beam a high-speed signal from that tower directly to small receiver antennas mounted on the roofs of your customers' homes.
Oh, wow.
Yeah. The second you turn on that central tower, Every single home within a multi-mile line-of-sight radius is suddenly considered passed. That is how you balloon your metric by 24% almost overnight.
That is a brilliant way to bypass the geography problem. But, if you're listening to this and doing the math in your head, you might be wondering about the disconnect between access and adoption.
Oh, absolutely.
Because passing a home is one thing, hooking them up is another entirely. And the actual high-speed customers only grew 3% to 142,500 subscribers.
Right.
So they pass over 500,000 homes, but only have 142,000 paying customers. What is the holdup?
You've just hit on the inherent friction of the telecom business model, and it's exactly what Greg Burns probed on during the call.
Right, because Burns essentially asked, now that you're moving past this heavy investment phase, what is the bottleneck? Why aren't you driving stronger subscriber growth right now?
Yeah.
Is it fierce pricing pressure from competitors? Are people just refusing to pay for faster internet?
The short answer is the brutal reality of physical infrastructure.
Hmm.
Remember, ATN spent $21 million in capital expenditures, or CapEx, just this quarter alone.
Just this quarter.
Yeah, that is money flowing out the door today to build towers and lay fiber for revenue that won't arrive until tomorrow. You have to build it before you can sell it.
Makes sense.
But when asked about a bottleneck in adoption, management politely pushed back on the entire premise. CFO Carlos Dolioli pointed to steady top-line growth in their fiber markets, but then the new CEO, Naji Khoury, chimed in with a very grounded perspective.
What did he say?
He explicitly stated that there is no mysterious bottleneck, no pricing war holding them back. The real task is simply the block-and-tackle execution of migrating existing subscribers off the old copper and onto the new fiber.
But, what does block and tackle execution actually mean? That sounds like classic corporate jargon to just brush away a real problem. Why is migrating people so difficult if the new internet is so much faster?
Because it requires intense physical logistics. Think about what it takes to upgrade a customer in rural Guyana or an isolated Alaskan town. You have to physically roll a truck. You have to navigate terrible weather or unpaved roads. An installer might have to drive 3 hours just to reach one house.
Just for one house.
Exactly. Then they have to mount an antenna or run a drop cable to the siding, drill through a wall, install a new modem, configure the network. You're doing this one single house at a time.
That is painfully slow.
It really is. It requires scheduling, manpower, and convincing a customer to be home on a Tuesday afternoon. For investors who are used to software companies that scale globally with the push of a button, this reality requires an intense amount of patience.
That makes a lot of sense. The friction isn't demand. The friction is the literal physical terrain. But, managing investor patience while you're simultaneously spending tens of millions of dollars on CapEx requires a pristine balance sheet.
Absolutely.
You can't just bleed cash while you wait for your installers to drive across Alaska. And that brings us to the strategy of the new CEO, Naji Khoury.
He has a very distinct vision for how to manage this transition.
Yes. His main catchphrase throughout the call was disciplined capital allocation, which, again, sounds great in a boardroom, but what does it actually mean for the operations of the company? What is he fundamentally changing?
Disciplined capital allocation means ruthlessly deciding where a dollar generates the most long-term value and not being precious about historical assets.
Okay.
And we're seeing exactly what that looks like in practice right now with the ComNet tower sale. ATN entered an agreement to sell a portfolio of 214 physical cell towers and related operations in the U.S. Southwest for up to $297 million.
Almost $300 million. That is a massive chunk of physical assets to part with. Why are they selling the actual towers? I thought the whole point of telecom was owning the infrastructure.
Well, it's important to differentiate between owning the network and owning the real estate.
Interesting.
Yeah, a telecom tower is essentially vertical real estate. The buyer of these towers wants the steady, predictable rent from carriers who attach their antennas to the steel. AT&I, as an operator, is realizing that having their capital locked up in steel and concrete just isn't the best use of their money right now.
So they're cashing out.
Exactly. They expect an initial close of that sale in the second quarter, bringing in between $250 and $270 million in gross cash proceeds right away. They are trading real estate for operational capital.
And what exactly is Khoury planning to do with that massive influx of liquidity?
Khoury was definitive about their immediate priority. They're going to take approximately $70 million of those initial proceeds and entirely wipe out the outstanding balance on their revolving credit facility.
Paying off the corporate credit card.
Precisely. And in today's macroeconomic environment, with interest rates where they are, that is a crucial defensive maneuver. AT&I's net debt ratio is currently sitting at 2.3 times their adjusted EBITDA.
Which is fairly high.
It is. By paying off that high-interest revolver, they drop their leverage significantly. They ensure they have absolute liquidity and financing flexibility to weather any economic storms and fund that expensive fiber transition organically without having to borrow more expensive money.
Okay, I love the safety of a fortress balance sheet, but there's no free lunch in corporate finance.
Never is.
If you sell 214 towers, you also sell the revenue those towers were generating for you every month. What is the cost of this safety?
That is the trade-off, and management was entirely transparent about it. Selling these towers will reduce their annual adjusted EBITDA by about $6 million to $8 million moving forward.
Wow, okay.
So they're making a strategic, calculated sacrifice. They're giving up a sliver of guaranteed future earnings to instantly erase a massive chunk of high-interest debt today. It's a bet that financial flexibility right now is vastly more valuable than those specific rent checks tomorrow.
It really reinforces the core thesis, right? Shedding the past to build the future, which leads us to the horizon for AT&I. Because while they are selling off physical towers in the U.S. Southwest to raise cash, they clearly aren't abandoning their rural U.S. footprint entirely. While they're reallocating private capital, they're simultaneously securing massive amounts of public funding.
You're referring to the BEAD program.
Yes, the Broadband Equity, Access, and Deployment Program. This is the federal initiative designed to get high-speed internet to the most underserved parts of the country.
Right.
The analyst on the call brought this up. AT&I noted they've secured around $140 million in provisional BEAD awards across the Southwest and Alaska, covering roughly 10,000 homes.
It's a huge number.
When you hear that a company with $182 million in quarterly revenue just secured $140 million in government grants, the natural assumption is that a massive revenue spike is right around the corner. So does this mean their balance sheet is going to just explode in the second half of 2026?
And this is where the expert management of expectations comes into play. CFO Carlos Doglioli explicitly threw cold water on that idea.
Oh, really?
Yeah. He stated very clearly that BEAD will have zero significant financial impact on 2026.
Zero impact this year. Why? If the government awarded them the money, why isn't it showing up?
Because of the glacial pace of federal bureaucracy.
Oh, of course.
A provisional award is just the first step. Before a single shovel hits the dirt, there are massive environmental reviews, complex permitting processes, local zoning board approvals, intricate network planning phases that have to be completed.
Red tape everywhere.
Everywhere. Material monetization, meaning actually getting the cash and hooking up paying subscribers from these government programs, won't happen until 2027 or even 2028.
So why should you, if you're listening to this, care about a government grant that is 2 years away from making a dime? Why did management even bring it up?
Because of what we just analyzed regarding the tower sale and the debt reduction.
Yeah.
Telecom is a game of endurance. For a company that has successfully wiped out its high-interest debt and fortified its balance sheet, they've bought themselves the runway to survive the wait. Those BEAD awards represent a highly predictable, incredibly lucrative future pipeline.
So they don't need the money today.
Exactly. AT&I doesn't need the BEAD money to survive 2026. They've already funded their own survival, which means when that federal money does finally hit the income statement in 2027 and 2028, it won't be a desperate lifeline used to keep the lights on.
Right, it'll just be growth.
It will be a powerful, unencumbered catalyst for immense growth.
Wow. Let's take a step back and look at the big picture here, because what we've unpacked today completely changes the narrative of that initial stock ticker shock.
It really does.
If you just look at the EPS miss, you see a failure.
Yeah.
But when you look at the mechanics, AT&I is a perfect case study of what the digital age actually requires. We all want high-speed internet no matter where we live, but getting that connectivity to the edge of the map, it isn't magic. It is a messy, capital-intensive grind.
It is trench warfare, literally and financially.
Exactly. It requires ripping out the old plumbing while the house is occupied. It requires ditching legacy copper networks, selling off prized physical assets like cell towers just to pay down debt, and absorbing the immense logistical friction of sending an installer down a 3-hour dirt road just to hook up one single house.
Yeah.
And they are attempting to execute all of this while Wall Street demands quarter-over-quarter perfection. It really makes you appreciate the underlying muscle this company is actually building.
It does. But, you know, if we pull back even further, Looking past the adjusted EBITDA margins and the fixed wireless expansions, there is a profound structural question hidden in AT&I's strategy, something that goes far beyond corporate
Put it
finance.
on me.
So, AT&I is intentionally shrinking its total subscriber metrics, right?
Right.
They're doing this to force the death of the legacy copper network, which makes perfect operational and financial sense. But what happens to the consumers in these incredibly remote, underserved areas who don't or can't migrate to high-speed fiber?
Oh,
What happens to the family at the end of that 3-hour dirt road if they can't afford the new fiber rates, or if the fixed wireless tower simply doesn't reach their valley?
they just lose internet.
That's the question. In the corporate rush to upgrade and modernize our infrastructure, are we quietly creating a new type of digital dark zone for those left behind on the dying copper lines? Or is forced obsolescence simply the only way to drag the future forward?
That is a heavy, essential question. And it brings us right back to our original metaphor, honestly. Upgrading the plumbing requires a ruthless focus on the future, but you have to wonder what gets left behind when the water to the old pipes is finally shut off.
It would be a really fascinating dynamic to watch unfold across the industry in the years to come.
Truly. Well, for everyone listening, thanks for joining us on this deep dive into the hidden mechanics of ATNI. Keep your eye on the muscle being built under the surface, question the headline numbers, and we'll see you on the next deep dive.